I'm Sarah Williamson, and this is Going Long with FCLT Global. On this show, you'll learn what it means to be long-term from the top minds in global business and investing. Leaders from companies and investment organizations join us to discuss how they are leading their teams for the long run on issues including capital allocation, risk management, climate change, and sustainability. To learn more, visit our website at fcltglobal.org. Welcome to FCLT Global's Going Long podcast. My guest today is Chief Justice Leo Strine. He is of Counsel in the Corporate Department at Wachtell, Lipton, Rosen Katz, as Distinguished Fellow, Pennsylvania and Columbia Law Schools. He speaks frequently on rights on the subjects of corporate and public law, and particularly the impact of business on society. And his articles have been published in numerous reviews. So we've all read many of the things that you've written and followed your work over many years and are grateful for your leadership in this area. So thank you very much for being on the podcast today.
It's great to be with you, Sarah.
So I'd like to start with this current discussion that we're having of stakeholder capitalism, or sort of the dichotomy between traditional views of shareholder dominance and more of a stakeholder mindset. Do you think that there's a real dichotomy between a company's investors and other stakeholders, or is the divide more between short-term investors, long-term investors? How do we pull apart this stakeholder shareholder question?
No, I think that's a great point. I think one of the difficulties we have is that the natural alignment between stockholders who have a genuine long investment in the company and who are invested in the company because they think the company has good prospects, they would like to see it succeed, they want it to be a durable part of their portfolio, and they're looking for sustainable growth in their portfolio from having that company in it, so they can put their kids through college or they can save for retirement. That perspective is really aligned, if you think about, Sarah, with what a CEO and a management team are trying to do with the company. They know that there are going to be blips quarter to quarter. They know that there are going to be situations where you have to put the long term over the short term. And they also know that in most industries, if you don't treat your employees and your customers well, if you're not regarded as a good public citizen, that it's difficult over time to attract the talent that you want. You don't get community support in ways that are important to you. And your consumers don't have as good a feeling about you as you would like, and they might be tempted to take their business elsewhere. The real problem is when it's this intermediation that we have of really the direct stockholders are another kind of fiduciary, and the incentives they have are often not the same as their long-term investors. And to be fair to them, they also are subject, Sarah, to some, difficult pressures, like the idea that 401k investors, as you know, can hop in and out of funds without any pricing metrics. That puts pressure on the investment managers to keep their short-term Morningstar ratings up, even at the cost perhaps of taking a more rational long-term approach. So I don't think it's useful to demonize anybody, but I think descriptively that the real problem is in the middle, and with how we align the interests of these institutional investors with the long-term interest of their investors. And then that will create the kind of alignment we need for company managers to run businesses in the way that we all probably think is most productive, not just for investors, but for society.
Well, I love the way you've articulated that. We often at FCLT talk about the asset owner, who's the ultimate owner of the assets with usually a very long-term time frame, the asset manager who's managing on their behalf, and then, of course, the company. And I think that the way that you've put it as well really highlights that those are not one and the same. And I think a lot of the discussion in both the popular press and even in some legal writings assumes that shareholders, that most companies are owned by mom and pop shareholders who actually know the companies that they own, and perhaps vote those shares and do all of those sorts of things, which we do in an idealized way, or even to take it further, are more like Adam Smith's butcher, who's a sole proprietorship. So clearly, that's not the world we live in anymore. And you've talked about this separation of ownership from ownership. ownership. What can we do to either bring that long-term shareholder closer to the company, or do a better job of getting the manager, the intermediary, to be acting on behalf of that long-term shareholder?
Yeah, I think that we have to think about what's practical. I know some people think about things like pass-through voting, Sarah. I just think that would be a nightmare. I mean, the reality is I'm almost entirely indexed. I do have an investment in the Fidelity Contra Fund who's had a remarkable manager, and he's like, the squirrel who typed Shakespeare or something like that, but I don't want to cast all those votes. And I think the institutions actually, as we know, already have a problem. So how is it practical that individuals are going to do that? But I think what is practical is, to be honest, for the asset managers to stop calling themselves owners. And I think we're starting to see that. I think about 15 to 20 years ago, I think there was a pretty unattractive tendency of money managers who hold other people's money to claim ownership and to pound their chest at what companies are doing. I think the move towards even the word stewardship is a useful word, because it implies that you actually have an obligation to someone other than yourself. So what I think needs to happen is, we're talking about double ESG standards. I use an extra E for employees because they shouldn't be buried in the S. We shouldn't just be talking about double ESG disclosure by companies. We should also be talking about disclosure by institutional investors of how they take those factors into account. I think, contrary very much to the Trump Labor Department moves, index funds should have to actually take double ESG factors into account because of the unique long-term perspective of their approach to investing. The fact, Sarah, that they own the whole economy, which means externalities at a particular company are costs to the overall portfolio, and that they're mostly running retirement money, which is inherently long-term, and that for 99% of American investors, most of what their wealth comes from is their job, and most of what they get to invest in to save for retirement is from their job. So they need companies that actually treat workers well. And so I think we should go from trying to gag their ability to actually take these into account to have some affirmative requirements on the part of people who are running retirement money to actually align their voting and stewardship policies with that perspective, and to have some disclosure requirements that make them actually accountable for saying, how do we factor that into our voting and investing? And so we're not just putting pressure on companies to do the right thing, we're actually supporting them in doing it. So I think that's one thing I would do. To be honest, I think a fractional trading tax throughout the OECD would be a quite helpful thing to everybody in tackling climate change and raising money in a way where we don't have to raise corporate taxes. And the reason it's relevant to our discussion is, I think a little trading friction around fund hopping would actually help the money managers who are taking a longer term perspective. I know there were times during the tech bubble and others that some value investors at mutual funds felt really down about themselves because they lost funds under management, the other things, and they turned out to be right in the long term, but some of them actually retired and they didn't even reap the benefit of their long-term thinking, but because people were glomming onto bubbles. A lot of the investors tend to sell low and buy high. And so a fractional trading tax would put a little bit of consumer consciousness around that, which I think could be good for, the mutual fund industry. And by the way, I think it would also deter some of the rapid trading, the other sorts of derivatives that really don't add value. I mean, we're not talking about something like a sales tax. The average sales tax in this country is 6 or 7%. We have people who buy plenty of goods with that kind of sales tax. The idea of a fractional trading tax of far less than 1%, that it's going to shut down economically meaningful trades, I think that's not right. But it might actually make some consumers say, hey, should I drop out of the long-term value fund or the index fund because the gold momentum fund is going in? Hey, I've got a little bit of pricing friction around that, and I'll have to think about that. That's not it's a Pigovian, to use the economist term for it, a Pigovian way to raise revenue. I also think bringing capital gains rates into some rational alignment, and I just, simple as we call long-term capital gains 1 year. That's not a long-term rate. And at the very least, and I think the Vice President Biden has proposed equalizing it, very late, I think you should have a long-term rate that's something like 5 years, where if you're going to reward something that is more akin to real investment, that again will help the asset managers who have a longer term perspective. It will reward the companies in a more durable way. And so rather than just demonizing the industry, I think we do have to realize that they face some real pressure, Sarah, and maybe give them a little help. And if we can do it in a way that raises some money, because we need that to tackle climate change and frankly, to close the deficit a bit, those are pretty good ways to do it.
Those are terrific suggestions. And I think that having, as you said, having something throughout the OECD would be very interesting. So you couldn't just get around it by going somewhere else.
Well, right. And I think that's why, the idea of an OECD-wide carbon tax and FTT could be a very powerful way for us all to pull together to raise money for climate change and to address aging populations. And frankly, squeeze out tax havens, like to really, we don't need the Caymans. I mean, we do, if you want to go to vacation in the Caymans or gamble, that's fine. But if you want to hide money there or the Channel Islands, not cool, and to have the productive economies kind of align. And we have, it would be a very efficient thing, I think, to do. And it also would allow us all not to put, have upward pressure on things like income taxes or, that we might view as, frankly, more negative ways of raising revenue.
So coming back to your point on the Department of Labor's announcement, and as we know, what they have said is that for ERISA fiduciaries, they should not take into account ESG factors. And in fact, they would need to justify taking those into account. At the same time, we're seeing other countries sort of go exactly the opposite direction. The UK and other places are saying, no, a long-term fiduciary must take these sorts of factors into account. Why is there such a difference? And there's a great divide across the Atlantic. And how can we bring these two together to think about this as really incorporating things that affect the long-term value of companies, as you've outlined, rather than this kind of trade-off mindset?
One of them is to start having secretaries of labor and secretaries of the Interior and the Environmental Protection Agency that actually honor the mission. And the mission of the Department of Labor is actually to further the well-being of American working people so that they have economic security both while they're working and retiring, and then they have safe working conditions and dignified places to work. And I think this is more an ideological position, in my view, of the current Labor Department than it is grounding in any rational understanding of the economic needs of American workers in terms of the retirement savings. I've done, I'm an economist, but I can read statistics. And what I said about the economic, basis for Americans' wealth is true. Even, Sarah, even in the top 5%, before you get to the 1%, wealth from work predominates. So, that whole idea that you can't take into account, therefore, when you're investing on behalf of people, of retirement savers, that are whether companies are actually treating workers well and whether they're employing American workers in a way. Well, frankly, if we don't employ American workers, it's very difficult for pension funds, as you know, to remain stably funded, right? And, people's 401ks, it's very difficult to fund your 401k if you don't have a good job. In terms of externalities, I said most pension funds, even as you know, actively managed mutual funds, often 50% or more of an actively traded mutual fund is effectively indexed. They have a very stable base, and then they have an active part of the portfolio. So even they have a real concern about externality risk. They're not long one particular company, right, Sarah, and then short the whole society. And so there's a shared interest, right, in having low externality companies that make money the old-fashioned way by producing high-quality products, delivering high-quality services, but not externalizing their costs to other companies and to taxpayers. And so I don't think the Department of Labor is even thinking like an economist. Because if you're an investor, one, if you own the whole economy, the sum total of each company's externality is a drag on overall economic growth. So that's going to pull down the long-term growth of your portfolio if you have a broad swath of stocks. Your investors also pay taxes. That's part of their equation. If you externalize to the taxpayer, their economic portfolio is not simply the gains in their stock, it's also their overall situation. And they also, frankly, incur the healthcare costs and other quality of life costs that come from unsafe products. And when we look at climate change, my gosh, I mean, again, if we're going to be scientific about it, there's a lot of economic damage. I mean, the volatility that we're already getting. I mean, one thing that's sort of surprising is you have a Republican Party that has so many people who deny not just what scientists say, but shockingly, Sarah, probably a very core Republican traditional constituency. I refer to insurance actuaries, all of whom believe that climate change exists, right? And are factoring it in. These storms and stuff and these fires, these are not without costs. These have huge effects on our economic growth. And so what the Department of Labor is sort of saying is, you're a trustee for people. You've got to deliver safe retirements for them from 40 years from now. But you should just not take into account all the real world things that are going to determine the real growth of the portfolios of the people you represent. Why? Because you think that that's some sort of political movement to just think about whether companies are externalizing their environmental costs or companies are not paying their workers well. I mean, I think it is ideological. And the reason, I think actually most of the business community rejects that form of thinking. And interestingly, I think the Business Roundtable, if you go and talk to CEOs, they don't support that kind of thing. They would actually, their concern, as you know, Sarah, is that the mutual funds and others are on too much pressure to actually give short shrift to longer term concerns. They would actually like to have a more supportive environment from institutional investors so that they can pursue longer term sustainable growth strategies for the company. So I'm not even sure how broad the constituency is for this. I just think it's actually a kind of ideological approach. And as you said, it's really out of sync with pretty much all the other market economies and where they're going. And I assume that this will be something that Vice President Biden's, whoever is at Labor, will move as quickly as they can to reverse. And I think actually it has to go in another direction. As I said, I think you have to go beyond May to some sorts of funds having a shall obligation to think about these things.
So one of the, so I like the way that you said that the pension plans are not long one company and sort of short the rest of the world. One group of investors that does tend to be long one company and sort of agnostic to the rest of the world are activists. And so, we've done a lot of work on activists. You've obviously spent a lot of time thinking about activists and the sort of difference of incentives that they have relative to most shareholders. Work that we've recently published shows that activists hold less than 0.3% of all of the equities, but obviously they have an outsized influence on what happens in the market. Can you talk a little bit about how, and we've also seen in the press recently, some activists try to portray themselves as long-term activists. And so how do you think about the role that activists are playing and how they line up against the standard shareholder, and is there any way to close the daylight between those two?
I wouldn't shut down activism, some would, but I think one of the things that's sadly lacking has been accountability for this powerful industry. I think like institutional investors overall, Sarah, there's been a real lag in the power they wield and then corresponding accountability structures. One of the things I'd like to see is some real disclosure about what they hold. Our 13D, the early warning system in the US is so out of whack. It doesn't cover derivatives, for example. So you don't have to disclose derivative positions. You can continue after you hit the 5% reporting threshold, you can continue to acquire stock until you publicly report, which means people have come public with owning double digits of the shares of public companies. I just think that's outdated, and especially with technology. The only reason for the old gap in reporting was you used to have to actually get documents on a train to Washington and prepare them. Other regimes have a 24-hour reporting thing. So I'd like to see the 5% at least become a real threshold. If you get the 5%, you stop trading until you report. You update every 1%, and you cover all derivatives. And I also think we should know how long-term they are. They should have to disclose their horizon. What I mean by that is if they have a fund that's going to have to liquidate in 3 years, we should know about that. And we should know all in about their position, which is, I actually think that there should be a net long calculus that has to be done to actually show how long the company some of these folks are, so that other investors, like some people have said, like the activists propose, management reacts, and then the center of the plate folks like Vanguard and Fidelity and BlackRock, will mediate. Well, I think those center of the plate folks need to have information about really how long-term these activists are. And I think they have caused real harm. And I would point to a couple of things. One is the huge decline in gain sharing with American workers. And that's profoundly different even than in the EU and OECD generally. The US effect is very special. And the share of profits that have gone into worker pay from increases in productivity and profitability has gone way down in the last 30 years. And activist pressures have been a big part of that. That has created much greater economic insecurity in the US, has led to nativist appeals, and has also caused us to stop. We are not closing the racial equality gap because Black people are much likely to be among that working class and the lower middle class. And when they first got an opportunity to get into the labor market, within 10 years of that, we really started all this shift in 1981 towards this approach. And since that time, workers have not been getting a fair share, and that's kept Black people from, frankly, moving up the economic ladder. And here's a COVID-related thing that I think you can actually attribute to activism and short-term stock market pressures. How many companies, Sarah, after receiving a huge tax cut that it's not clear they did anything to benefit the economy with, and after 10 years of economic recovery, right? So it's been 10 years into a recovery, huge tax cut. How many companies didn't have the reserves to even last 6 weeks without basically laying off their entire workforce? It's one thing, I understand this has been a very difficult situation for all kinds of companies. But households, we're taught as middle-class people, or, to have some reserve. These companies had 10 years to build up reserves. Why didn't they do it? Is it because these business people aren't smart? No, I think it's because, to be honest, if they had any reserves, they would get savaged, as you know, by activists. Part of why they didn't give workers things is because, frankly, some of the short-termism debate is a little off, because sometimes it really wasn't investments in R&D that were cut. It was the workers. I mean, we kept the R&D, but what we just did is we shafted American workers. And then we come to the pandemic and we don't have any reserves. The workers are getting hit the hardest. And frankly, it turns out that the people we need most to keep our economy going, the essential worker class, are the people we actually pay the least. And I do think that activists have had a big effect on it. And I think to have, frankly, some of the things like trading taxes and some of the capital gains stuff, eliminating the carried interest windfall, that's a useful thing, but some real disclosure around it and accountability for them and being honest. I'd like to also see disclosures because they take money from charities and pensions and others, Sarah. I'd like to see them also have to disclose more about their track records. I don't want them having to disclose like a 13F, like a mutual fund, but they should actually have to have a real track record under criteria established by the regulators, and they should have to keep it current. And they should also have to disclose whether they give preferential terms to particular investors, because we know there's a lot of charitable money, pension money, and others that comes in late in the game in those funds or doesn't get as good deal as the others. And, it's one thing if they're only having, I'd date myself, I always call it the Thurston Howell exception from Gilligan's Island, the really rich guy who can invest or lose all his money. When they're investing a small college's money, a pension fund's money, a charity's money, that affects all of us. And the lack of information required of them to be given to their investors is just shocking and out of date. We have a sort of mid 20th century regulatory regime addressing a 21st century economy, and there needs to be a refurbishing around that. But that's some of the stuff I do. I wouldn't shut it down, but I do think it needs to be rebalanced. And I think there's also, frankly, too much insider, trading. You see around before they disclose, Sarah, you see unusual trading returns for other kinds of activists. And more ordinary people who are invested through mutual funds don't get those gains. That's not really a fair part of our economy. And all we're asking, I think, is that they start playing by the same rules that we really expected they would have to from the beginning.
So one question that I've always had about activists is, maybe you can help in terms of their fiduciary duty when they go on a board. So sometimes you see activists put somebody on a board. They nominate a director, and that director joins the board. That director may or may not specifically work for the activist, but they have gotten them there. How do you think about the hat that board member is wearing when they walk into the boardroom, and how do they separate that sort of duty to all of the shareholders from that loyalty perhaps to the person who got them in the room?
I actually favor them being on the board as opposed to what I call the drive-by shooting. What I mean by that is if they can get what they want, Sarah, and not actually bear a fiduciary duty, that frees them up to sell. So I actually think they should be in the board. I think they should. I've always suggested that if an activist comes at a company, that the company say the following: are you willing to go on the board, and are you willing to serve on the audit committee? And are you willing upfront to pledge not to demand any kind of green mail exit, and that you will exit in an orderly way? And if you have to suffer a block discount because you want to dump the stock, you suffer a block discount. But you're going to promise never to ask us to waive these rules. I think, those are good things for people to understand. I don't think there's any inherent conflict, to represent a large block holder. I think obviously the company has to have informational policies, Sarah, about what appropriate use of the information is. But I don't mind. I actually would prefer them be on the board, but they do have to serve on the hard committees. If they come in and say, I won't serve on audit, and it does act as a lockup, as you know. I mean, when they have a board seat, it subjects them to some things, and I think that provides some useful discipline. I have been dismayed, though, by the number of companies that have come. They've come in, they've worked their magic. The magic hasn't done anything, and then they get a preferential buyout. And I just think that stinks. And I think one of the things that companies could do up front, and frankly, start demanding. The list I just gave seems to me one's Fidelity, BlackRock, State Street, and Vanguard ought to be asking. Their money is long. So I think that would be useful things for the good people there thinking about the bona fides of somebody, of how, and that's would go along with, I said, like a net long statement. Like, what do we really know? If it turns out you're so hedged that it's really not like us, we should be able to take that into account. But those are a few things I would do. I think one of the problems with activism too is so few of them actually have any former operating experience that the tricks are just so, how many of them have gone into retail and sort of come to realize how hard a game that is, or that somehow it's a real estate play, but the real estate is built for retail. Is there some obvious way to convert it to something else? If it was built to be a Best Buy or, something like that, is it going to, Best Buy, I think, still long, but think of something I used to like. What was that book chain? Borders. What is Borders going to become but another retail? And if retail is closed, and so part of the issue is that they really have pretty blinkered imaginations. I mean, it's pretty much to split up something, put something together. I mean, most of it tends to center around either M&A pressure plays or increasing current liquidity. And I'm not sure all of those things, although we all have fun with M&A. There's a lot of inefficiency of how many companies have been glommed together, pulled apart, glommed together, pulled apart. That has long-term cost in terms of disruption to people's lives and the economy. And then the liquidity point I think we already talked about, which is there's actually a lot of literature that shows that gains from activism may mostly result from transfers from creditors of companies, debtors of companies, and workers of companies to the activists and to the stockholders. And one of the interesting things, Sarah, that we haven't really talked about is for most people, a responsible part of your portfolio, particularly as you get closer to harvesting the money you need for your kids' college or retirement, is actually in debt securities. And you think about how the voice of debt has actually gone down over the last 50 years. They tended to used to be a long-term capital provider for a company. They would often have somebody on the board. We now have sort of turned that all into, basically a commodity, securitized it. But except when the debt is distressed, there's really not a whole lot of voice behind it, right? And so for a lot of Americans, if you're retired, probably 40%, it could be 40% of your portfolio, right, at least is in debt. And so if activism is simply shifting gains from debt holders and workers to the equity holders, the distribution effects of that on ordinary people are, probably fairly negative when you think about how ordinary people make their money.
Yeah, the voice of debt is an interesting phrase because I think the debt holders don't tend to have much voice, as you
No,
said.
right. They don't say anything, Sarah, really, until there are, as you know, active debt, where distressed debt funds, right? It tends to be when it goes thing, but when the companies, over time, when it really can go from investment grade down, there really isn't, we haven't developed any comparable requirements for the fiduciaries in that space to use any sort of voice.
So
and because, and I mean, you also don't get the benefit of the kind of long-term debt monitoring you do when you had an old-fashioned bank. People would say that maybe that bank constrained you from taking some risks, but that also means they probably constrained you from hitting some rocks. You know what I mean? Is they would have somebody who would really know the capital ratios of the firm. They would actually study the firm. When you have the securitized debt, you don't really have that those eyeballs at the table in the same way. And I think those eyeballs probably tended to help all corporate constituencies. A lot of the worst things is when companies just have a debacle, something where you go into insolvency. And so having some of those folks who do kind of focus on some of the core financial risk and whether you're being prudent with your money, that can be a valuable thing to have around. And I don't know that we have, much of that until we get to the point where it's distress. And then when it's distress, it looks like, frankly, it doesn't look that different, as we know, Sarah, from other forms of activism. And usually the ordinary investor class is getting hosed by that point in time.
Well, at that point, it's just sort of dividing up what's left. So the rating agencies, in some ways, are meant to be those eyes and ears or voice for the debt holders. Are there things that we should be doing to embolden them?
I'm sure there are. I just think that's it. In some ways, it's like asking. This space is almost as if you imagine as the only thing you had was ISS and Glass Lewis. Mm-hmm. Right? Like nobody at Vanguard, Fidelity, BlackRock, or anybody else was actually doing anything. And it was just ISS and Glass Lewis putting a name on something. I'm not sure it can really work that way. And so I know they've had failures in the past. I don't think that they're bad people or anything like that, but I think that it's really difficult when you don't have the actual asset managers who are overseeing the debt funds really doing anything. And then it's all ratings game. And the thing that underscored that to me was the way the tranches were rated during the financial crisis. I don't understand how any tranche, any security portfolio that has a large percentage of subprime can be rated AAA. I can understand how it can get to investment grade, Sarah, like by a blend. AAA is the best, right? And it's like saying, I go to a steakhouse and you're going to give me, a quarter of my steak is eye of round. I'm sorry, that's not AAA. That's not Kobe beef ribeye. If it may be okay. I might be doing it. I mean, I might still enjoy it, but don't charge me, $100 for it, and don't tell me it's AAA. And so I think one of the problems is that the incentives obviously are to push more and more stuff out. Volume. One of the problems with ISS, why, in my view, one of the reasons why we have say on pay every year is that it helps those. That is a place where those folks have a role, and the more noise there is, the more there's a role for them. And so they recommend having votes pretty much monthly. Now they say, oh, we don't like it, it's a real burden. Well, yeah, it's a real burden, but it's why you're in business. And so I think if, one of my overall things is I think we could do a lot to actually take down some of the noise and make it easier for asset managers to focus on what they should, but they need to be part of that. And I actually, as I believe, for example, in having say on pay votes every 4 years, have a quarter of the companies eat up every year. And as long as you don't make a material change to the plan, you hold them accountable over the 4 years. That would allow the institutions to really focus on the plans. It would create a real accountability structure. Instead, we have this, every company has this pay vote every year. We know that people can't focus on it. And so when the company has a bad year, it becomes a vote not on pay, but just the company had a bad year. And the pay continues to soar. But there's a hoo-ha machine that allows a lot of people to make a lot of money as intermediaries. And the American people kind of get to sit back and watch it.
Yeah, I think that's if there were a way to have real focus instead of as you said,
but it comes from if you talk quietly to the folks at the major mutual funds, they know there are too many votes. But aside from BlackRock and maybe State Street, none of them will vote to move the say on pay every 4 years. My friends at the CII, I have respect for them, but why not, be part of the solution? I'm not talking about giving away your voice. I'm talking about making your voice meaningful and mature. If one of them would say that they believe CEOs should be on year-to-year contracts, then I'd respect them. I think they would be wrong, but I at least respect that they're aligning the vote with what they think. They think that CEOs should be having longer-term pay plans. So why not have a vote, bind yourself in them, and then see how it looks in 4 years. A quarter of the companies coming up would allow for focused voting. Instead of having so much influence by the advisors, take a look at yourself and be somewhat responsible. But to actually overwhelm the system in part because of yourself with meaningless votes, then outsource the vote, because on the say on pay, frankly, that is where ISS and Glass Lewis tend to have the most influence, is because you can't keep track of it. It's a silly system, and it actually has a lot of cost for Americans on all levels, because it does create levers for short-termism, because anytime you can have a vote on anything, as you know, Sarah, that gives you somebody a chance to get in there. But it also just detracts company management from being able to focus on more meaningful tasks. And we have a whole apparatus around, like what I call the model UN of corporate governance. It's almost more vibrant than the American, our actual polity is about votes, but it's just people playing with other people's money.
So if you think about the priorities that boards have in terms of focusing on executive compensation, focusing on how they, we talked a minute ago about debt holders, focusing on the shareholders, all the issues, focusing on the EESG issues that come before the board. You've said that corporate fiduciaries need room to be creative and take chances, make mistakes. There's so many issues coming at them. Obviously, people make mistakes. How do you ensure accountability with a lot of leeway for a board, but then accountability for making sure that either they get it right or that they're trying hard to get it right.
I think I think you have to, even if we were to sort of go towards stakeholder governance, like on a B Corp model, you have to recognize that none of the core protections of fiduciary duty law are going away, which is self-dealing, can't steal, that kind of thing. And by the way, no stakeholder wants corporate management to steal, particularly the workers. So that's going to be there. And you have to remember that on all these structures in the US, really stockholders remain the core constituency. It hasn't been any changes in corporate law that have really made companies more responsive to the stock market. It's really the power that stockholders get to wield through the electoral process. And so I think if you rebalance the system to give boards a little bit of leeway, for example, the so-called Revlon doctrine, right, Sarah, where you have to sell to the highest bidder and stakeholder concerns go out the window. Well, if that was tempered and you could actually say in an auction, look, we're going to sell, but the rules of the game for the auction are you're going to have to treat our workers and communities well. We've taken PPP loans during the pandemic. We've gotten tax subsidies from our communities in order to build these plants. Our workers have taken concessions. And so in the bidding process, there's going to have to be fair regard for them. If you can win the auction, we're going to go to the highest price, but it's the highest price that treats everybody with fairness. I think that's a useful rebalancing. And ultimately, remember, only the stockholders get to vote on the sale. So if they don't want to sell that and they want to remain independent, they can turn it down. Ultimately, they get to vote on the board of directors. So the board of directors in the United States, you elect directors, even under the evil classified boards, and I don't believe they're evil. Even in the evil, classified board in the United States, you get to elect at least 3 directors a year, and those votes are really influential. And unlike in Europe, where there can be years at a time when you don't have a director election, in the US, there really is an annual meeting where you elect people to the board. And also with the competitive product and services markets, as you know, Sarah, in which companies compete, I just think for all those reasons, it's very difficult to see American companies having a lot of leeway not to take the legitimate desire of stockholders for a fair return, not to legitimately expect that a for-profit company makes profits. I don't see that real danger. I think the danger we actually have face and is costing us is what we talked about, which is that the people voting the shares, the people who are really exercising the direct influence, are not the ultimate owners of the company's risk, and that the pressures they're putting are not as rational as they should be and is not as aligned with productive means. So I think a little bit of rebalancing to maybe give managers a little bit more chance to manage in a sustainable way is helpful. I also think that if you can restore that some of the desire for top executive compensation will be muted a little bit. What I mean by that is I think CEOs used to feel better, and top executives in general, about working for companies because of what the companies did in the community. They were regarded as a good employer. I think we've lost some of that because we've asked them to really be instruments of the market, to frankly injure historic communities important to the company by closing plants and other operations, by downsizing, by offshoring jobs. You don't feel as good about the job and you demand something in exchange. And so I think if we rebalance a little bit, some of the, and I view it as hypocrisy, some of the asset managers who both call for CEOs to do kind of really gross things and to tie all their pay to total stock return and then complain about how much they're making. Perhaps if we all, pause, exhale, kind of remember what it's all about a little bit, that there'll be some space to actually bring CEO pay into a more normal sphere, to give managers the ability to enjoy their jobs better and to chart a long-term direction. And I still think there'll be plenty of accountability because it's just impossible to survive without being a profitable company. And by the way, workers, the constituency that cares most about profits is not stockholders, it's the workers, because workers, they have, as you know, Sarah, a non-diversifiable investment. this is their job, and people want to feel good about the products that they're making and the services they're delivering. And even more important, they know for themselves that if the company's not succeeding, then they're not going to have a job very long, and they're not going to have a raise. So they actually really do want the company to succeed. And so I think in that basic tension between whether long-term stockholders and workers at companies have any real divide, I don't think that that's a real thing. And I think if we can reduce the tensions, I think we're going to find company managers who often, frankly, care very deeply about the workforce, would like to do better by them, and actually care about being regarded as a good community leader, that they'll probably feel better about their jobs, and maybe they'll demand a little less.
Well,
but on that front too, we also have to have institutional investors who are willing to make sure top managers have a fair part of their pay in cash. And actually, if you care about things like sustainability, like double ESG, then a portion of the executive compensation, a meaningful portion, has to actually recognize the fulfillment of those objectives. And I think that's particularly true for general counsel, sustainability, and risk officers, to make sure that institutional investors are making sure that those people are rewarded fairly for what they do, and that those people's pay is not tied to something like total stock return, but the actual metrics that they're accountable for, achieving for the company on those important dimensions.
Well, maybe we'll wrap it up there with your comment to take a deep breath and remember what it's all about, because I think that alignment of interests from the worker through the general counsel, the sustainability officer, the CEO, the long-term shareholder, if we can get that alignment much more in focus, then that is what is one of the things that can really help us make serious progress in this area. So for your time today, thank you for your leadership on this issue and your very, very thoughtful writings and speakings about this. And thank you for being a part of this. So
it's been an honor to be with you, Sarah, and thank you for everything you and your organization are doing to make our economy work better for everybody. I'm very grateful.
Thanks for listening to today's episode of Going Long with FCLT Global. Be sure to hit subscribe to get new episodes every other Monday. To learn more, visit our website at fcltglobal.org.